There's companies that are profitable and $200 million plus that unsuccessfully sell in processes all the time. It's more of a show me and not a tell me at that point. I think the number of Americans that are suddenly comfortable with injecting themselves has gone up a lot, and I think it will continue to. It's like there's this virality, right, of society.
Nick McCoy studies what separates niche consumer brands from the ones that break into the mainstream. As managing director of Whipstitch Capital, he analyzes the trends shaping food, beverage, supplements, and wellness. From creatine gummies to mass market health products, he's tracking where the next generation of consumer winners will come from.
The consumer now, the CEO of their healthcare, and they are taking charge of their healthcare, and that's kind of what you're seeing. Primary care physician is really more focused on acute things, which is what they're really trained for. My daughter goes to school, and all the kids are talking about, their neurodiversity and what prescriptions they on, and it's almost like a cool thing. It's like people are coming out of the closet almost,
Nick, thanks so much for joining me here today. How are you?
I'm good. How are you?
Good, thank you. Really appreciate you jumping on.
No, thank you for having me. It's a pleasure.
When we first connected a few weeks ago, we talked a bit about how there's a biohacking functional. When we first connected a few weeks ago, we talked about how there's the biohacking functional health movement that's going on, and I keep hearing more about it. Like also, MAHA as well has become very prominent. Tell me about your views on that and how you view that segment.
Yeah, I think it's interesting. I think there's a big picture thing going on here, which is, when I was a kid and, even 10 years ago, the CEO of your healthcare was your doctor. That we went from traditional insurance to managed care. Everybody had this primary physician that was doing referrals, and that person was basically in charge of your health at the end of the day. If you didn't have a referral, you couldn't get reimbursement, and so they kind of had a lot of power. And as kind of the internet has expanded and AI has come, and you've got things like peptides and things like and med spas suddenly everywhere. I mean, med spas have doubled since 2018. We're over 10,000 now. That doesn't even include like individual doctors that, are non-insurance taking doctors, that concierge docs and things like that. So you have kind of all of these sources available and information available. And it's really made the consumer now the CEO of their healthcare, not the primary care physician. The primary care physician is really more focused on acute things, which is what they're really trained for, and not necessarily, prevention, which is so big right now. So, the consumer now kind of sits between the doctor and all of these other things, supplements, better for you food, peptides, all of that, right? Over the counter things, meditation, right? All of it. And they are taking charge of their healthcare. And that's kind of what you're seeing. And as far as like food and beverage and brands go, this is having dramatic impacts in terms of the growth, the uplift.
Totally. A few months ago, I was talking with an Australian founder of a wellness company. And what I thought was a really interesting insight that they said was, in Australia, there's such trust in your doctors, in the healthcare system, that consumers actually don't really need to know as much about biology, or don't really kind of care to know much about biology, just because there's kind of so much trust in the system. Whereas in the US, it's almost the complete opposite, right? Where you actually now, don't have as much trust in the healthcare system. You're making your own choices when it comes to what's actually readily available to consumers, versus going through your healthcare provider. So then also as well, you actually as a consumer want to be a lot more informed about your own health as you do, versus, in this example against Australia. And I thought that was actually really interesting too. That how different it can be, not just for American consumers, but in different countries too.
That is interesting. Yeah. I mean, I'd be curious kind of and I don't know that much about that market other than it does seem like supplements that do really well there tend to do well here. Mm-hmm. It's kind of a good I mean, per capita GDP is not too dissimilar, so I guess maybe that makes some sense. But I don't know what their training is like there, and kind of, what is the healthcare paradigm, right? Is it just acute, or is it acute and prevention, or somewhere in between, or
Yeah, no, that's a fair point. That's a fair point. She was just saying how the American consumers are a lot more educated about these types of topics versus that she's found the Australian consumer, just because there was actually quite a bit of trust in the healthcare system, where it seems like here in the States there really is not nearly that trust, or certainly that trust has gone down.
Yeah.
Yeah.
Yeah, I believe it.
Yeah. And as well as what you're describing is also, transitioned to better for you food and beverage, and is growing faster than the rest of the store at the grocery store. And as where you sit on the M&A level, are you seeing multiples reflect that growth yet, or is there still a lag between consumer momentum and deal pricing?
It's an interesting question. If we're just talking about multiples, the kind of headline, biggest headline type deals, the most attractive companies out there tend to trade for very similar multiples, even during good times and bad. That I would say has stayed somewhat level. What happens is during the kind of slower times in, the capital cycle, and slower times in the M&A market, you see, as the attractiveness level goes down of companies, the multiples fall away faster. And during the kind of more active times, they kind of don't fall away as fast. And I think right now we're moving from what was, in 23 and 4 or so, was really a really tough time. I mean, it was kind of a triple whammy on innovation and, better for you, and just slowing down of the capital cycle between interest rates and inflation, and, people migrating back to restaurants after COVID, which was, causing unit volume declines in grocery stores. I mean, it was just a really hard time to be a brand. Now we're migrating back into a much more normalized, growth environment, with this tailwind of actually better for you growing at rates like 7% faster than the store, which is above the average of kind of 3 to 5% we've seen over the last decade or two.
Are you, if you can elaborate a little bit in terms of the hard times of 2023, 2024, and are you also sensing on the M&A side, for example, there was much profitability mattered a lot more, for example, than it did now, or how did that actually translate?
Yeah, I think profitability actually has continued to matter more over the last decade, continually. And part of the reason is because these companies are getting larger and larger before they get bought. In 2010, companies that were 10 million in revenue were getting competitively bid on by strategics. And now you have to be north of 100. Yeah, I mean, I remember there was a company called Attune Foods. They made Uncle Sam cereal, and they got bought by a public company, so I can say the numbers, but it was about a $10 million revenue company and about a $10 million deal. Post bought them, and I think they had 8 bankers go pitch the company to go sell it. Which it was like a really sought after deal in 2009 or 10 or whenever it was. And it just shows how different the market was back then, compared to today.
And that deal, when you say that deal, so that deal was definitely bought, not sold. They were not trying to sell, but they had so much attention and action.
So a $10 million revenue company, a $10 million revenue branded product company at the time was kind of ripe for sale. Yeah. I mean, they ran the sale process, just like a lot of other people do now, but you would not get the same result today. There's companies that are profitable and $200 million plus that unsuccessfully sell in processes all the time. So, I mean, the thing is, if you're $10 million and you're not profitable, and, you're a big strategic, and, you've got Cheerios in your portfolio, which is, a billion plus brand that makes a lot of money, you've got a lot of room to grow and scale to get to profitability, right? So you can run a model when it's 10 million that says it's profitable by 30 or 40 or 50. But if you're buying a brand at 200, you don't have that much more scaling room. You kind of want to know what that EBITDA margin is going to be like on that brand. And it's more of a show me and not a tell me at that point.
Can you give us a rough idea in your mind when a brand should be EBITDA positive? And I know that it obviously depends on different categories, right? Depends on if it's a
Yeah.
beverage company or food, but roughly in your mind, when does it actually matter?
It's a great question, and it really depends so much. So beverage is really an interesting example because you kind of get to this size where 40, 50, 60 million, where you start to get more approaching profitability or maybe even slightly. And then to grow more, you have to think about moving your distribution to DSD. And when you go DSD, it means you're going to be spending more money in your distribution. Granted, you're going to be getting more sales because you've got somebody actively stocking the shelves and keeping the product looking good, and doing it every day, and not stealing space from your competitors, and not letting them steal it from you. So it's a plus, a net plus, but it is going to cost you in the short term in your margin. So you have this kind of like dip, and then you get profitable again. Whereas in food, you're going direct at that point, which takes out the distributor and actually gives you more of that retail on the shelf dollar. It means you're actually getting, instead of maybe 50 cents of the dollar on retail, you're getting maybe 60, or a little bit more. So, but it's tough. I mean, there are food companies that are $10 million and they're profitable. And then there's then it also depends on how fast you're growing. And I've seen food companies that are over 100 million and growing at 30 or 40% a year and not. And that's okay because they're spending the money economically. You can't capitalize marketing investment.
Right. That's fair to say. How do you kind of judge if it's all right? And I guess you never quite know until in hindsight. But when do you kind of, if you were to analyze a brand, for example, how do you think about, is this the right time to sell? For example, are you going to drive the most amount, or is this the most amount of like attention you're going to get at this point in time, and kind of the highest price, that will be paid for your company?
Yeah, it's a great question. So, when we look at brands, we look at what is kind of the brand headroom. And by brand headroom, we mean if you look at where the brand is proven that it can be sold, and you look at, online, selling, through Shopify themselves off the website, as well as other e-commerce retailers like Amazon, Thrive, etc. In store, looking at conventional, natural, drug, mass, club, all of the channels, and food service too, right? There's branded food service. And where are they kind of proven, and how big can they get in that channel? Looking at other analog brands, as well as kind of their own performance trends, you come up with a number. And if a brand is at 100 million and it's got a $300 million headroom, well, if you're going to sell it to a strategic, you can probably run that brand up to 200, 225, and you've still got this kind of growth, right? When you get up to 300 and you're bumping against the top of that headroom and you flatten out, it gets really hard to sell somebody that you're going to get to 500 or 600 million, right? So you want to have that growth momentum on your side, but you don't want to lose it because you compromise a lot of value as soon as you flatten out. So there's kind of a sweet spot that happens there. Now, you can always go into new categories. You can always go into expanding by whatever, adding a protein version of whatever you're doing, right? But you have to prove those things out for them to really count in headroom.
Well, can you tell me a little bit about how you actually calculate, like the calculus behind headroom? And then I'd love to talk to you about single category versus platinum too. But let's start with, in terms of the calculus on the headroom side.
Yeah. So the mechanics, if you're looking at a category like Spins Mulo, which is drug, club, mass, and conventional grocery, there's ACV, which is all commodity volume, or basically what percent of the channel on a volume weighted basis are you. And so if a brand is at, let's say, 20% right now, and they have an average of 3 SKUs on shelf, which would be 20% ACV would be 3 SKUs times that, or 60 TDP. TDP divided by ACV is your SKUs on shelf. And then they have a velocity, which is expressed as dollars per TDP. And that's basically, how much velocity per each TDP are you running. And so the first thing to do is look at how far can you go in ACV. And you can look at other analog brands. Like if you're in the chip aisle, it's pretty hard to get more than 50% ACV as an independent brand. If you're in frozen, you can get, I look at brands like Kodiak that got well north of 70% when they were independent. You start getting to the point where every little bit that you add is averaging down your velocity because you're kind of maxing it out. But you can get to higher levels. So you kind of look at the category and you look at analog brands, and then you look at how big a brand block can you get, or how many essentially how many SKUs on shelf in each store. And some categories like baby food is like probably 30 or 40. But if you're in cottage cheese, it's probably going to be 4 or 5, right? So it varies by category, and you can look at that with the analog brands, and then how much velocity looking at it. So if you look at frozen, frozen meals could be $150,000 or $200,000 of TDP, and you're going to be perfectly fine on shelf. And there's a lot of brands that sit there. But if you're in frozen pizza, it's probably going to be north of 500. Obviously, makes sense. It's dollars per inch. Pizza's a bigger box, so you have to sell more to keep the retailer happy, right? And then it's basically just mathing all that out, and you get to a store volume sale. So you get to some number like 100 or 200 million, and then you just back into what does that mean in wholesale dollars to the brand. You divide it in half or so, and kind of get there. And you just do that across the channels, and that's kind of how we do it. Add it all up, and you have to factor in things like Costco, which are not reported in spins, but are easy to do. The brand knows how much they sell per SKU per store per week, and if you're 1,000 SKU per store per week, it's about 25 million a year wholesale, because Costco has a very uniform margin.
Are there any retailers that you have to kind of discount, or like you mentioned, for example, Costco, for example, is not in spin? Is there any, or even like DTC sales, for example? Is there anything? How do you think about the different sales channels based on price?
You mean will they be successful or not in a retailer?
Yes. No, not so much in a retailer, but when you think about what the value is, if they're trying to be sold, and what the value is in terms of all the sales channels, are there any sales channels that might actually be more valuable versus ones that are less valuable?
Sure. So for beverage, convenience is very valuable. Okay. Convenience has a higher potential for beverage sales than conventional grocery on average. If you look at dollars per TDP of larger brands in convenience, they're 2 to 2.5 times what they are in conventional grocery. Food is more like 1.3 times or so, and it's very limited what actually sells in food very well in convenience. So if you're a beverage, it's pretty valuable. If you're in food, there's not a lot of expectation that you're going to necessarily get big there, and only certain categories can. But for the ones that do, it's great incremental growth. And then I think, another thing to think about too is how deeply can you penetrate these retailers? And I think Walmart is one of the best examples. There are brands that do really well in 600 Walmarts, and then when they go to 1,200 or 2,000, it just falls right off. And then there's other brands that can go to 4,000 Walmarts and maintain, velocities that aren't that dissimilar to how they do in 1,000.
Why is that the case in Walmart?
I think it's because the demographics and the planogram, or the lack of uniform planogram in these stores. A lot of these stores weren't built as food stores originally, and they were kind of converted. So that means that they may not have certain sections, or so sometimes a brand will get placed in an area where it wouldn't necessarily be in the rest of Walmart's. What one example that comes to mind, and I always talk about things that are much older because I want to be careful about information, but about 7 or 8 years ago, there was a brand out there, which is still out there, called Flapjack, and they have these little mighty muffins that's like basically like protein powder, and you put water in it, microwave it. It's a great product. Well, when they went into Walmart at first, they in a lot of the Walmarts, they got placed in the nutrition supplement section. But when you went to Kroger, they were in breakfast, which is kind of where they belong.
Wow. Yeah.
But the Walmart breakfast set is not uniform like a Kroger breakfast set. They have a cereal set, and they've got in a different aisle, they got, at least at the time, the breakfast bar set. And so this was kind of most closely resembling nutritional supplements. So they put it there. And of course it didn't sell as well, until, yeah. So I think that's part of it too. And I think there's legitimately a price point, issue with Walmart, and Walmart is doing a really good job at expanding in Better For, and bringing in more consumers that are are buying more premium goods. But I do think that there's a number of Walmarts where there's more price sensitivity than others.
Yeah, no, we talk about a lot about the show about what types of products can actually cross that chasm and go from natural to mass, which is a product, I'm sure you see this all the time, where a product could sell really well in natural, for example, but then not be able to kind of cross that chasm. And, and it is a great business in natural, right? But it's never going to be, a massive business because it's not in mass retail. How do you kind of analyze that from your seat?
It's a great question. So one thing we look at, and this is kind of geeky, we look at the ratio of velocity of MULO to natural in spins. And generally speaking, if that number is above 12, MULO is 12 times the velocity of natural, then it's a brand that is going to do better in mass over the long term. And if it's less, if you get down to brands in that kind of 6, 7, 8 range, it's sometimes hard for those brands to break 15 or 20% ACV in conventional grocery.
Okay. Wow. So there's a specific data point that you kind of rely on in order to figure it out. Okay.
And it's category dependent. That's not totally uniform, but it's definitely something to compare across brands within a category. And you can see very clearly which brand kind of resonates more in the mass market with consumers.
This is a ignorant question. Miro, what does it stand for?
MULO, multi-unit. Oh my God, I can't remember. Multi-unit something outlet. I just can't remember off.
Unit. Okay, cool. I'll no, I appreciate that. Very, very cool. Yeah, because that's the number. I have a lot of investors that kind of come on this show, and that's the number one thing when it comes to ones that invest in food and bev and CPG about, can you actually cross that chasm and go from natural to and actually be successful in mass? Because it really makes sense from a VC perspective to get involved if you cannot do that. And a lot of the times you're kind of making investments that a company, their traction has only been in natural. So you don't truly know. So I do think that's quite interesting.
And I think in food and beverage, particularly, it's probably more meaningful. But when you look at like supplements, which really under index in conventional retail, they're just so heavily D2C, and and then you've got mass stores that sell supplements really well, like Target and Walmart and things like that. And then natural, of course, right? And if you look at clean beauty, and clean kind of, personal care, there's a lot of that may not, get beyond 12 or 15% ACV in MULO. And some of those brands are really valuable. They can be 100 million plus because they've got big D2C sales. They're selling in the beauty stores. You know what I mean?
Because they can actually be profitable on D2C and actually be profitable on those channels where food and bev
in mass.
In mass, but well, they don't actually maybe need to rely on mass as much, right? Like the beauty, and then also supplements, for example, because they can actually have a very profitable D2C business. Whereas food and bev needs to rely on mass because you can't really have a profitable, or it's very hard to have a profitable D2C business.
But having the success in retail, if you're doing well in Target, Walmart, and a few other select, conventional areas, maybe some club and natural, and some of the beauty channel, as well as that D2C, adds a tremendous amount of value, right? Because the big buyers are, they're experts at selling in stores. They want to see that that's word out.
Yeah. So if you have a brand that hasn't yet gone into mass and wants to sell, do strategics look at that as saying, hey, there's an opportunity here because we can buy it and then, of course, we can do a mass? Or do they want to see typically some type of proof point that it could work in mass?
I think the proof point is always going to add more value. But again, brand specifically, there are times where, they just love the brand. We sold a brand called Eucora 4 or 5 years ago, and they were all D2C at the time. And it was a successful process, and it was fine, but that's not every brand.
Fair point. I also wanted to talk to you a little bit about the current economy, and from a consumer lens, we hear the term all the time, K-shaped economy, for example. What does this mean in context of food and beverage, and how broad is the growth of Better For You?
Sure. So the K-shaped economy actually refers to, if you look over time at how much do the top 20% of America spend in total, and I like to look at spending and not how much wealth do they have, because, again, our whole business drives off of spending.
Right.
And, the top 20% of America today spends about 57% of dollars, and the bottom 80 spends 43. And, that number, literally, it looks like a K. It's like this, like over time, 20%'s gone up and the 80%'s gone down. But what's interesting, if you look at food, the top 24% or the top 26% spends 24%, and the bottom 76% or 74% spends 76. So it's actually just about uniform. Every customer that walks through that Walmart door is an equal opportunity customer at the end of the day. Some reasons for that: well, wealthier people eat out more, right? So that's one of the equalizers. And right now we are seeing low income is actually the fastest growing area in better for you. And it actually was earlier this decade too, when SNAP benefits were really high in 2021 and early into 22 as well.
Wow. Unfortunately, you cut out there for a little bit.
Okay.
Do you mind just repeat that? We'll edit everything out. I'm more than happy to ask the question again if that's helpful.
Yeah, sure. Yeah.
Cool.
Or I can just start the answer again if you want.
Right, go for it. Yeah, that'd be great.
Okay. Okay, when we're talking about the K-shaped economy, we're actually thinking about a graph that looks like a K, and this is basically how much money are households spending. If you track it over time, the top 20% of households are basically increasing, and today they're spending about 57% of expenses of total consumer expenditures, and the bottom 80% are about 43, and it's over time it looks like this. But when we look at food, actually the top 74% of households spend 76%, the top 26% of households spend 24%, and the bottom 74% of households spend 76. So it's very, very equal comparatively to the rest of the economy. People eat about the same amount of calories, and wealthier people eat out more. But basically, every customer that comes into that Walmart is an equal opportunity customer, which is really interesting when you think about, hiring to make sure that you understand to reach every customer that comes in that door, because each one can give you exactly as much bottom line profit, because retailers make the same margin pretty much in everything they sell.
So does this mean that maybe you shouldn't segment like in terms of like consumers, because almost anybody can be a consumer of your product since because of this, or how do you think in terms of like the insight?
Yeah, I mean, low income right now is the fastest growing area of better for you. I mean, it's growing from a smaller base, but it is growing, a couple points faster than higher income in terms of, better for you growth. Interestingly, at the end of 25, Nielsen IQ did a consumer survey of SNAP households and wearables. And what they found was SNAP households actually were adopting wearables in December of 25 at 4 times the rate of the general population. And in the beginning of 25, it was more like half the rate. So over the year 2025, and part of this is probably because of, Obamacare benefits going away and things like that, that adoption rate just spiked. When you also think about it, wearables are durable goods. And so there is a second sales cycle that happens. People get an Oura Ring version 1, it wears out, or they decide to buy another one, they pass it off to somebody else. The stated intent of why were they adopting a wearable, number one was managing chronic health conditions. So, if you want to save money and going to the doctor, you can get a wearable, you can get a continuous glucose monitor, you can start, monitoring it yourself. Metformin is almost free. So you can get prescriptions super cheap and stay on that cycle and to essentially be the agent of your healthcare again.
Wow. Yeah. It's as someone who's wearing an Oura Ring. Yeah. Totally. That's really interesting. I wanted to also talk about hypodermic needles. I know that you mentioned this last time when we talked about how if you look at Amazon data, you're seeing 850% year-over-year growth in these needles. And it's not just GLP-1 alone. What's the signal that you're actually tracking with this, and what does this tell you about where consumer health is headed?
Yeah, this is a great question. So that number actually came from a essentially a data scrape that Nielsen IQ did, and we looked at 30 gauge needles, which are basically the small ones that they use for insulin injections, and also basically anything that you're going to inject subcutaneously. So that could be testosterone, which can be done two ways. It can be done into a muscle. It can be done subcutaneously. All of the peptides, which includes GLP-1s, of course, being the biggest one. So yeah, I mean, I think that is more people who are either buying GLP-1s in larger sizes to save money, and then basically using, essentially multiple needles or more than they're going to give you when you get your GLP-1 mail prescription from Lilly. They kind of give you, kind of one per vial or maybe a little bit more. And so you have to go buy, and supplement. Or it's people who are going to the gray market to save even more money and, acquiring it themselves or through compound pharmacies and things. And then they're buying all the needles. And it's also all the peptides. The peptide market, well, there's not great data. We did look at, trying to pull data, and what we found is the websites for these peptide companies seems to change. Interestingly, so you kind of get these weird data charts where they kind of show growth for a year and then it goes down, but it kind of is replaced by another line, which is the same probably credit card account, but a different website or something like that. We couldn't really figure it out. Clearly there's growth, but we don't have great data behind it. But I can just tell you anecdotally, the number of peptide sites, the number of peptide manufacturers in China that show up on these this one website, I can't remember the name of it right now, that literally you can send your vials to test what's in it for free. And then they basically will post it with the manufacturer, what it was, endotoxins, how, purity, what percent, like how many milligrams are actually in the vial, all of that. So anybody buying from, any of these vendors in China or whatever can go online and look at the history of the tests of the vendor and figure out if they trust them or not.
Wow. That's really,
it's better than eBay. It's better than eBay feedback.
that's really interesting. How will what happened 2 weeks ago with RFK Jr. bringing, I know it's not bringing 12 peptides off the category 2 list, and how will, or they're not off the category 2 list. It's for a review, right? That's happening in a few months to hopefully have them removed, or maybe have them removed off category 2. How will that disrupt peptides in your view?
I think one of the things that RFK has done, without, probably even somewhat indirectly here, is just his vocal presence and his, number of hits in the news is raising awareness around health, across America. I mean, just somebody out there saying MAHA on a weekly basis, this news around these peptides. He was on a podcast with Joe Rogan. I think it was about a month and a half ago. He mentioned that in that podcast. There's been discussion about this, in other summits and things like that he's been involved in. And it's kind of spreading the word around peptides. So just spreading the word is raising consumer awareness. So consumers, when they're going to their med spa or their doctor, are asking questions about them. Now, doctors couldn't prescribe, traditional doctors couldn't prescribe peptides when they're on, when they're on category 2. The fact that they're now available at compounded pharmacies is going to be able to change that. The ones that are on that list, the doctor has to be comfortable with it. It seems like med spa doctors probably are more comfortable with it. And concierge doctors are more comfortable. And I think it also just means that you're going to see probably prices start to drop on those peptides too.
Yeah, I'm also curious if doctors are able to prescribe peptides, if what the consumer then market will become. Like, will there still be a consumer market for peptides? But I'm just kind of curious how much, what the demand will be like for what the demand will be like kind of D2C to consumer if you also have the prescription from your doctor.
Right. Yeah, it's a great question. I mean, there is gray markets out there for, a lot of prescription drugs now, generally things that are older and, less dangerous. So, people get this stuff anyway right now.
Totally. Well, speaking of peptides, what do you see as the future of GLP-1s and their impact on the consumer?
Yeah, this is really interesting, and this is something that I know a number of kind of thought leaders in the in the data companies. We spend a lot of time talking about. Right now we're at 12% officially on GLP-1s, so that's 12% on people who are on FDA regulated, semaglutide, which is GLP-1, tirzepatide, which is GLP plus GIP. Some people call GLP-2, and that's 12%. There's some number, we don't know what it is. I mean, I've seen kind of 1 to 2%, and personally, I believe it could be higher, of people who are on, those drugs plus retatrutide, which is, kind of the next one that's coming down the pipe here through gray market or other, compound pharmacy or other sources. There's a cycle where these people lose weight. I think about half of them are on for weight loss, and about half are on for, diabetes, metabolic, things like that. Either way, there's a cycle of losing weight where people eat restricted calories, and then there's basically a stabilization that happens. It's like if you take the same dose, you might start at 200 and you're just going to kind of tick down. And then as you approach maybe some number like 160, it's different for everybody, right? You kind of level off. And then the only way to keep losing is to increase the dose, or obviously whatever, build more muscle and cut calories. But, if you're on a GLP, you're probably going to be, increasing dose. And so you reach an equilibrium. And so then, you're going to be on this kind of stabilized level. So I think 10 years from now, 30, 40% of America, could be even more, could be on stabilized GLP for metabolic, and or weight management issues. And so what does that mean? Well, people are more conscious of protein just because they've had to worry about muscle loss. Retatrutide is supposedly better at muscle preservation. But there's this concept of people getting skinny fat where, they've lost 30 pounds, but 12 has been muscle and 18 has been fat. And so, they don't have kind of that, the figure or whatever in some ways that they did. Fiber is really important. Fiber's not sexy like protein. I imagine if I was in high school right now and I was walking around in the, around school, I'd be flaunting my 42 gram protein drink. But I certainly wouldn't be flaunting a 20 gram fiber drink, right? I mean, it's just not, it's not sexy, but it is really sexy if you're on a GLP-1 because it keeps you regular. And you don't want to get up and be bound up every day.
So if there's an increase, right now we're at 12%, if that goes to 30, 40% of people that are on GLP-1s, do you think, because right now, for example, when you're at Expo West, you see a lot of brands and protein is a huge call out, right? And they still think that we're at kind of peak protein. Do you think then that we are in kind of peak protein, or you think it's just kind of just getting started, this whole wave, because of the GLP-1s, if there is that increase that goes from 12 to 30%, if that happens?
Yeah, it's an interesting question. I don't think we're at peak protein. I do think that it is going to continue to increase, but we may be at peak protein growth. I think that it really depends on how much this group and our society in general adopts weight training, because I think that that piece of wellness definitely gets people to be more conscious of it. And lean muscle mass is really, in strength, is really correlated with longevity. So, I think that is something people pay attention to on GLP-1s, definitely. But if that 30 or 40% and even the, in the remainder is doing more weight training, then I think we're going to see continued protein growth.
Got it. Yeah, that makes a lot of sense. And how are you thinking just peptides in general? Maybe we'll take GLP-1s and put them over here and just other peptides, right? How do you think about, what do you think that there's going to be what do you think are the opportunities for strategics, and where do you see those going? I know we talked a little bit about RFK and having these 12 peptides off, but how do you see the peptide market developing?
Yeah, it's a great question. So there's, right now, peptides are basically chains of amino acids just strung together, kind of like letters and words. And, if you get the right combination, it forms basically a word or a message. to activate something in the body. And there's hundreds of them out there. There's thousands in the body. So the potential for, thousands of peptides to be in the market, it's almost infinite, right? The potential of this. So, in some ways it could be, a good piece of the future of medicine, right? I mean, there's plenty of peptides in medicine now. The question is, how do people make money on it, on that side, when it's very difficult to patent something, which is literally, a protein that, or I guess if it's less than 40, technically it's not a protein, right? Something that's just out there, right? It's you have to have something innovative essentially to patent, or you have to, just like in GLPs, be given essentially a special, mechanism to patent. So I don't know how much that's going to be on the drug side, or how much of that is going to be available on, the company side. But if I look at like the copper peptide right now, it's interesting, GHKCU, that is approved topically, and it's in, lots of serums and other, creams and things like that. And it's, very effective for, kind of skin rejuvenation and skin health, and sold that way. And it's obviously something that's contributing to efficacy in personal care, and that's driving growth in brands. Most of the peptides are not bioavailable, through the mouth, like in the stomach. So, I think that probably is more personal care. I mean, some are, but many are not. Then the question is, well, you've got all these peptides, and somebody's got to figure that out. And so you've got things like Hims and Hers, and Function, which is right. Obviously doing all these blood tests, which are having you figure out what's wrong with me. So maybe the peptides are something that are going to help me because there's something that came up in my function test, and I'm doing something else, and that's going to support it. And so I think in the kind of the service business around them, I think there's going to be a lot of opportunity. And, there already is, obviously. Hims Hers is a public company. And then, obviously med spas, right? Again, in that service side. So I think it's a little bit of like, we're going to see. But as far as like kind of food and beverage and all of that, I think it's basically a tailwind, because everything that you're doing around all of this healthcare, diet is so fundamental, right? Because you can sabotage your peptide work, your workouts, everything that you're doing with a lousy diet. And you can figure that out real quick, because you just don't feel well, especially as you get older.
Yeah, that's really well said. That's really well said. Yeah, I think, obviously I know the Amazon stats when it comes to needles, but do you think, injections, needles, do you think that's just going to be something that's going to be everyday common, that people are not going to have a fuss about in terms of form factor?
I think the number of Americans that are suddenly comfortable with injecting themselves has gone up a lot, and I think it will continue to. I think there'll always be people that elect not to. There's more and more oral versions of GLPs coming out, mm-hmm. In kind of the pipeline. So, I think there will be people that will avoid it. But yeah, I think especially as people talk and, people hear from their friends, oh, well, I took whatever, BPC 157 after my knee surgery. And, instead of taking 12 months to be able to, be fully healed, I was healed in whatever, 5 or 6, or, it's like, there's this virality, right, of society, just like with brands. Brands hit this inflection point where they suddenly don't have to spend as much marketing money to grow, and they just seem to grow. And that's kind of when they hit this critical mass of virality, where people are like, hey, I love this new whatever, cracker, potato chip, whatever it might be, right? And all of a sudden you see brands kind of take off when they hit this critical mass. And I think you could see that too.
Yeah, I think it's a fascinating consumer behavior that's maybe becoming more normalized. Just injections becoming a lot more normalized. Where, even if some supplements, how gummies have become more normalized when it comes to supplements, especially Groons, and you have also Create and other brands. But what's interesting about that is that gummies, easier, right? A lot easier to take than maybe mixing a powder and doing mix it powder and water and then consuming that. But needles, it's quite different. So it's just interesting to see how some of these are becoming more normalized. Some that are easier to do, like gummies, and then some that are a little bit more harder to do, like injections.
Yeah, and I think when I'm talking about injections being more accepted, it's definitely subcutaneous leading the way. I think people still would prefer not to go into muscle. I think subcutaneous are small little needles. It's kind of quick, painless, easy. Yeah. But gummies are interesting, definitely. I think 4 out of 5 people would definitely eat a gummy over taking a shot.
No, for sure.
Maybe not out of 10.
Speaking of gummies, I remember that you've said that gummies are also a pretty tough form factor because, only 20% is the active ingredient. You have to have quite a bit of sugar as well in the gummy itself. Do you think that gummies are going to become a lot more normalized? I mean, obviously, we just saw the Grüns transaction, and like I've said, like Create, for example, just raised $20 million. But do you see gummies kind of spreading across multiple categories, or do you think that it's still going to be too hard because of the amount of sugar that you have to put into it?
Yeah, it's a great question. So, and at the end of the day, so first of all, I have family that is in the gummy formulation business, so I've learned a bit just in discussions, and it is definitely kind of humbling to hear how difficult it is. You get like different batches of pectin, and that can screw up your the consistency of your gummies just because of one ingredient. And so the 20% isn't a hard fast rule. I mean, one thing I think that really helps Create is they're at 30. When you look at it, they've got, basically 1.5 grams of creatine in every 5 grams of gummy, which is 30%, which is pretty good. But I think, again, we're dealing with grams. So if the active ingredient is, 300 milligrams and it's still at the 20% level, well, that's only 1.5 grams, right? So that means 1.2 grams of sugar. That's 5 calories. That's pretty de minimis, right? Mm-hmm. So creatine is something that people are taking, traditionally 5 grams, and now for brain health, I've heard numbers like 10, and I've actually got one friend the other day that told me they take 20 every day, and I was like, wow, yeah, that's quite a bit. But obviously, they're blowing the doors off at Create, and they're selling big bins of them, and so it works really well, right? When you can get 30% and make it easy on people. So I think it's always going to be an easy form factor, right? It's easier to eat gummies than take a pill. There's a lot of people that don't want to take medication. They don't want to take pills. Beverages have done extremely well over time and gotten a lot of growth because you can get active ingredient into beverages, and people can, that is their supplement essentially.
Yeah, no, that makes a lot of sense. Yeah, and I imagine your friend that's probably taking 20 grams of creatine is probably not in gummy form, I would think, just because of the added sugar there. But
I mean, think about this just to highlight the point. How much money would America spend on caffeine if they took caffeine pills versus buying beverages, right? But we don't do that. We want the beverages, right?
Right. That's a very, very fair. I did meet somebody who said, if I want caffeine, I just pop a pill. I just pop a caffeine pill, and he's the only person still I've ever met that said that.
I was going to say, I don't know the data, but I bet it's less than 1 in 100. Yeah. And it always will be. Right?
Exactly. I actually recently, though, had a caffeine spray company come on the podcast. So
Oh, interesting.
Yeah.
That's interesting.
So I thought that was an interesting form factor. Talk to me a little bit about testosterone therapy as well, adoption. What's really interesting is women is driving this trend, which seems counterintuitive to a lot of people. What does that unlock? What are your why do you is anyone actually positioned for this, or what are your kind of thoughts on this trend as well?
Yeah, so I think hormones are really interesting because I think it's one of the kind of core fundamental, again, consumer as agent of healthcare things. There can be a lot of things that bother you in life, and it's real easy to go and you find a pill or whatever it might be for it, and kind of tamp it down. That can be cured with just optimizing hormones. If you're really deficient in testosterone, you're going to be more tired. You're going to be less focused. Once you kind of get yourself regulated, it can cure a lot of those ills. What's interesting about I think women's health is an area that is got a lot of growth in it, and specifically around hormones. What's interesting is all of the testosterone clinical trials have been done with men. There's never been one done for women, and they're probably never will be because we're using bioidentical hormones now. And so there's no financial incentive to do one, right? And it also means that doctors are less comfortable and have been less comfortable prescribing them. There was also a really unfortunate study done with progestin. I think it was in the late 90s, where a bunch of rats got breast cancer. And that stopped a lot of women from, taking hormone therapy for a very long time until that study got debunked. I mean, I can't remember exactly the type of rats, and I'm definitely not a rat expert, but, when you do these studies, there's multiple kinds of rats. And, there's rats that you use that can tell you if there's a high likelihood of getting cancer or not. And then there's other rats you use to figure out what kind of cancer they're going to get, because they'll get cancer almost 90% of the time that you run any study with them at a high level. And I don't remember what kind of rats, but I had understood at one point it was not necessarily the optimal selection. And then progestin it's a synthetic. And, we're using bioidentical now, which are believed to be much more benign, much less risky. And so now we're kind of coming out of that. And, I also think hormones are kind of like mental health. I mean, I think people didn't want to talk about them, right? I mean, 10, 20 years ago, kids didn't talk about mental health in school. It would, if you were the kid that had to go to the nurse's office, right? There's some shame, right?
Yeah.
And I think there is a little bit of that with hormones too. And, now it's like my daughter goes to school and all the kids are talking about, their neurodiversity and what prescriptions they on. And, it's almost like a cool thing, and I think we're seeing that more with hormones. And, even with guys, I mean, guys don't like to talk about anything, right? I mean, women are much better, I think, at communicating with each other about vulnerabilities. But I go to the gym now, guys are always talking about it now. It's like people are coming out of the closet almost,
Totally. Are there any subcategories within mental health that you think there's any white space that you don't think is touched yet?
It's a great question. I think again with like the hormones and the mental health, when we think about supplements and food and beverage, again, I think these are the things that are creating those tailwinds. So if somebody is on testosterone and they have more energy and more agency, and they're going to have the ability to build more lean muscle mass just by doing the things that they're doing every day, walking up and down stairs and things like that, they are going to be starting to think about different things in their diet. They may be more inclined to start weight training, when they start seeing that result. They may be buying more DHEA and things like that to take with their testosterone, especially if they're doing something like clomiphene, and that's their building blocks to build it, for men. Women, obviously not. So I think mental health is, it's a little bit of the same way. It's, you're doing something already here to kind of, maybe it's a prescription, maybe it's, hormones, maybe it's, meditation or whatever it is. And you're adopting your diet because, if it's just not going to work if all you eat is sugar and, your sugar is going like this all day, right? That's wreaking havoc on your nervous system.
Totally.
Your whole body.
Totally. That makes a ton of sense.
Yeah. So I think this is the rising tide, right? The more people are kind of regulating, I think it's more of a rising tide on innovative and better for you.
Totally. Yeah, absolutely. And then also as well, you then also have a lot more trust, right? With the regulation comes a lot more trust too.
Yeah.
How, in terms of your inbound mix, is it founders? Do you find that it's founders selling because they want to or because they have to?
I think right now it's more they want to.
Okay.
Yeah. A couple of years ago, 2020, late 22 into 23 was a really tough time, I think. And there was definitely a slowdown in the capital cycle. And there was a kind of lack of liquidity, again, because when interest rates go up, that means that all the people that fund the, venture and private equity funds suddenly they have a choice of higher rate bonds.
Right.
And, if last year bonds were 4% and this year they're 8%, you're going to allocate a little bit more of that direction. Right. Inflation was hard on the consumer. We had this hit of, a reduction in, unit volume in grocery stores. That was a headwind everybody was facing. So, big strategics were kind of, their stocks went down, and that meant they were less aggressive in M&A. Like all of that just was like a perfect storm.
So what you're saying is we're back.
We're back. Yeah, yeah. I mean, we're not frothy. I mean, we don't have whatever 20 IPOs and SPACs like we did in 2021. But we are seeing IPOs now again, which, by the way, really before 21 we didn't see in this industry. There's very few. I mean, we had Annie's and you know, yeah. I mean, there was a couple, but there weren't that many.
Yeah, right. Right. We haven't seen a lot of
Fresh Pet.
Lee, Givalda. Yeah. Yeah. We're certainly a lot of appetite on that side. I mean, a couple of companies I know that are kind of Europe
Yeah.
to be happy to IPO.
Yep.
Obviously, we had this jolt, 2018, 2024. That was really tough times. Have strategics everything like that just kind of adjusted toward this new norm, and that's why there's been a lot more activity because interest rates are still high, right? I mean, they've gone down a little bit, but they're still high. Is it just more so that we've kind of adjusted this new normal and kind of from the ZERP era?
Yeah, I think so. I think the change in interest rates is the more shocking thing. And once you kind of establish a new normal, even if you're an insurance company and you're holding your portfolio allocations the same, well, your bonds are making money and you haven't invested in private equity in a couple of years, and you start getting money back out of funds, and so now that opens up, and you need more, to put more there. Also, I mean, interest rates are high, but we do have some inflation right now. And, I think we always have to think about interest rates relative to inflation because inflation actually is, it's increasing revenue as well, right? It means you have a greater ability to take price, out of necessity. But, there was a few years in low inflation times back in, the 2010s where it was extremely difficult to take price.
That's a good point. It's a very good point. Which buyer profile are you finding that's most active right now? I know that we've kind of, the big ones are, the strategics maybe, but do you find that PE, for example, is a lot more active, or family offices? And has there been a shift within the past 12 months?
Yeah, interesting question. I think there's been a shift over, let's say the last 12 years, really 12 plus years. I think the number of large strategics has not grown nearly as fast as the number of innovative, ready for sale companies. And so by the way, on average, they do about a deal a year. Big strategics do. So PE has really kind of filled that gap. IPOs have filled it a little bit. I kind of put family offices into that PE bucket. And yeah, I think PE is definitely growing more. It's interesting. One thing that we track is we look at spins, and we look at in spins how many companies are over $100 million and are not, co-ops or farms or family farms that are just never going to sell, like actually companies that will be saleable brands. And how much is that number going up? And we started tracking it a couple years ago, and their numbers were like in the 50s, and now we're up to 89.
Wow.
And yeah, more than half, and that's retail sales. So that doesn't necessarily mean company sales.
Right.
More than half of those companies have some kind of an institutional investor, and about 3/4 of them are between 100 and 500 million. So kind of right in that sweet spot of acquirable. They index better for you, north of two times, and they're growing at 3 or 4 times the average, the average of other companies. So it is a group that is appealing and growing in size. So we are going to see more transaction volume, or we're going to see more strategics, one or the other.
That's really interesting. Well, I mean, speaking of strategics, Fernando Fernandez, who is the CEO of Unilever, last year said he is allocating 1.5 billion euros to every year for acquisitions. Grüns was this year, obviously. Are there any brands that you think will be their target for next year?
It's a great question, and I don't know specifically. I think Grüns was really interesting because I think the most interesting thing about that deal was the time from inception to sale,
Yeah.
and and $1 billion type tag on the deal, right? We, to my knowledge, have not seen that in food and beverage before.
No, it seems like
What is kind
it was reported it was the fastest ever. To
yeah.
get to $1 billion. Yeah, totally.
Well, and I mean, like in tech or whatever, I'm sure that's happened, but that's new for food. It just shows how it's matured. Now, I remember about 12 or 13 years ago, there was a company called Rickland Orchards. I don't know if you remember it, but they had Greek yogurt bars. And they went from inception to sale in, I believe it was 20 months. But they only sold for a number like, I think it was 55 or 6 million. It was a public deal, so you can look it up. Not speaking out of turn here, but at the time that was, that was as headline grabbing as Grun's today, right? So it just kind of shows you how the market is evolving into, and maturing into such a, much, much bigger, right? Everything is much bigger now. It's hitting a much bigger consumer base. And so we have this much more spending power behind, the potential of these brands as they just become more and more mainstream, as health becomes more and more mainstream.
Do you think, because of the Grun's transaction and other M&A transactions over the years, Poppy, for example, and kind of others that are tough, Rhodes, do you think that there's going to be a lot more capital that kind of goes into consumer just overall as a category, food and bev, beauty, personal care, VMS?
I do think we're going to continue to attract capital. Yeah, I mean, I think the more that we see large headline deals, the more that we see IPOs, then capital comes and chases it. I mean, capital is really dominated by, is really driven by fear and greed. And I think of the two, greed can be the more powerful emotion.
Yeah, that's very fair. Because I just think it's interesting. Mid 2010s, right? You had a lot of tech going into CPG and kind of these categories, and many of those deals didn't pan out. And I do wonder if we might get a point of, with all these headlines and all these news and all these transactions, that the tech money might actually come back, or any of it might come back.
Yeah, or just more funds that are, more multi-billion-dollar, multi-strategy funds increasing their consumer allocation.
Totally. Is there a category that I know we talked a little bit about protein and fiber, but is there a category that looks hot from the outside right now that you'd actually pass on, or you actually don't think is that attractive?
Yeah, it's interesting. I get asked the category question a lot, and what is so fascinating to me is when you look at founders, founders have a unique eye on a consumer that you or I, or the senior executives at all these large CPGs don't have, and they see this need from a unique viewpoint, and then they craft their brand, and drive all that passion behind growing it and satisfy it. And it, I mean, for years and years and years, like frozen was considered, in 2011, 12, 13 or whatever, nobody would want to go into frozen, right? I mean, it's like it costs so much, the margins aren't great, whatever. And there was a tremendous amount of innovation in frozen, right, over the 10 years that followed that. So there's a category that people would have said, this is an expensive category, to operate in. The margins aren't that high or whatever. Why would you ever go into it? Yet there was a lot of success, right? So I don't think there's necessarily a bad category, outside of, what are things that are just directly combating, or directly pushing into the headwinds or combating the tailwinds of, what's going on in consumer. But I mean, even like candy, I mean, there's companies in candy that are just doing fantastically right now. They've got, prebiotic fibers in them. They've got less sugar. They've got, they're capitalizing on like kind of that sour and sweet combination, right? I mean, like these kind of complex flavors are things that really resonate with GLP users. Things that are beyond just simple salty and sweet, those are under indexing. But when you put those with, sweet and salty, or, sour and sweet, you put those together, that's where you start to see them over indexing. So it's interesting.
Do you think, for example, like one that I think is kind of a hot debate in CPG circles is protein? For not necessarily saying that, protein is, but is there a limit to protein in terms of category, right? Like protein marinara sauce, protein popcorn? Is there a limit to where protein actually sits? Can it actually, fluctuate throughout the aisle? Yeah, I don't know. I'm curious if you have any thoughts.
It's a really good question. I think if protein can be formulated into something in a way that it is additive or not detractive of what you're buying. So if it's going into whatever marinara sauce, and the marinara sauce still eats like any other marinara sauce, then no, right? I mean, there's going to be somebody that's going to want to buy it. I think type of protein is something people are, quality protein and type of protein are things people are going to look at more and more. But I don't think there's necessarily a limit on where it can go. I do think that the intensity of protein demand, meaning like what percent protein by calorie, is something that is going to level a little bit as more people go on maintenance mode in GLPs versus this intense, I'm eating 1,000 calories a day and I've got to get 100 grams of protein. So that's 40% by calorie. So I'm going and, drinking beverages that are, 160 calories and 40 grams of protein and like nothing else, or these super high, like, protein servings to try to get that. Because it's really difficult, if you're on a GLP-1 and losing that kind of weight.
Totally. Yeah. That makes a lot of sense.
I mean, it drops to like 20% by calorie when the 1,000 calories goes to 2 and you're in maintenance mode,
Mm-hmm. Mm-hmm. Yeah, definitely.
And I think that opens up where it can go. It means that, there are areas where you can't put protein because, at that level, right, and have it be good. I mean, I can't imagine you could, put protein in marinara sauce at 40% by calorie, and have it work. I don't know. I don't know what the numbers are in the, but you know what I'm saying? Like, I think it actually opens it up so it actually could go to more categories at 20%.
Yeah, that's a fair. You're saying, yeah. So protein can even go into more categories in terms of what it currently is.
Yeah, like it's drying on baked goods, right? Like I've seen protein cookies, and when people try to put too much protein in, they get really dry, right? So 40% may not work, but 20 might.
Right. And still obviously have the taste, have it tasting great, which, because, obviously taste is king.
Yes.
If, let me think. Okay. I think that actually, all right. Final question. Yeah, this is great. What's one book? I actually forgot to put these, I think, on the question, but what's one book that's inspired you personally and one book that's inspired you professionally?
So I actually changed that.
Oh, I see. What events in your life? Okay, let me ask you yours. Let me ask you your way. What events in your life have inspired you personally and professionally?
It's a really good question, and there's lots of things. But I'll tell you a couple quick stories. So one was I when I went to college, I was in a dorm that had a lot of athletes in it, and I was 17 years old, and I was pretty underdeveloped. I was kind of that tall, skinny kid that didn't fill out in high school. And, I've got all these guys that are whatever, playing football and baseball. And, we had like weights in there and stuff. And so, immediately I was like very motivated to, start lifting weights and, fill out and try to figure that out. And I did. It was a lot of work. I actually, started mail ordering supplements at the time because that's what you did. And it really started to focus me more on nutrition and food and things like that. And, I think that kind of seeded some passion around wellness, early on. And, as kind of times went on, I worked in technology for a while and I really didn't like it. I loved, I really loved the uncertainty of consumer brands and the puzzle of like figuring out, does a brand work? And so kind of the early 2000s, there was like the .com meltdown, and that was kind of the point where I was starting to really lose, the luster of working in tech. It wasn't as interesting. and I, started doing consumer deals in 2020, 2003. That's when I went to my first Expo East. Over that decade, my mom got sick with Alzheimer's and died. And, I think that also kind of was really tough and depressing. And it kind of made me think more broadly about wellness. I got her into like a phase 3, trial. And, so I learned all about that. And of course, unfortunately it didn't work because nobody's really developed a great cure for Alzheimer's. And then I had 2 kids, right around that same time, around 2010. And, obviously you want to kind of like do the best for your kids and, figure out how to get them to, learn and love the best foods. And so I think kind of all of that has really, slowly and over time more and more kind of, broadly opened my eyes around, the breadth of this whole, consumer kind of health and innovation movement. And I just honestly just love this puzzle of what is going to make a brand resonate with consumers. What's going to make consumers direct their spending some certain way versus another way. Because it's a very dynamic question. Like consumers change every day. What works in 2016 would not work in 2026 necessarily.
Mm-hmm. Yeah, no, that's a very I also really appreciate the vulnerability and you sharing your story. But yes, I completely agree with you in terms of what do consumers think about today and how that will change as it does. So that's yeah. And also, I'm so glad you made the change to consumer from tech. I think it's got a lot more interesting. Yeah.
Oh, it's much more interesting.
I do think it's very interesting. I agree.
It is.
Well, Nick, thank you so much for your time. This was loads of fun. Thank you so much.
Yeah, thank you. Thanks for including me here. This is great. Really appreciate what you do.